So when I see Netflix down nearly $14 today, I think you should buy this dip because this story's just too good to ignore. You're getting a second chance. The largest original series from Brazil. Brazil. I mean, what does Brazil produce that makes, soy?
We are well aware of their incredible reach, their ability to create content in all sorts of different markets, for it to have a global footprint.
Right.
They're spending more than any service by far. And now I will try to bring you back to what that means for the stock price right now. So just wrap it up for me.
Okay. Well, sometimes it's not up to, I'm surprised at you. I'm surprised that you're bound by what sounds like the four walls of the spreadsheet. This is Tesla. This is Netflix. This is Amazon. I mean, these are what they're basically is TAN. They're TAN or NAT, but that's North American Tanker. Nordic American Tanker, you don't want Nordic American. But these are companies that people just say, best of breed. I'm going to give it some room, let it come down, and I'm going to buy it again. Because they are, we called it law school, really make me really be pompous here, sui generis, David.
Understood.
No one else has a Netflix.
Right.
I remember trying to get,
you can't even sit here and name all the pluses out there that are streaming services.
David, 142 million viewers in Squid Games. And I still haven't watched it yet.
Bruh.
All right. Today is Tuesday, April 19th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. I mean, this is better than Netflix, right? Ooh, what a beating. Anyways, let's dive right into it. In focus tonight, the Netflix disaster. And give us the after hours chart of Netflix. Let's see how it's doing. And ooh. Oh, no. Give us the Elmo with the fire. Matter of fact, give us the nuclear bomb, or better yet, give us the asteroid and the end of life. This is as bad as it can get. The stock of Netflix lost over a quarter of its value after hours. And this comes on the heels of the quarterly report, perhaps the most disastrous quarterly report in Netflix's history. So what went wrong here? Netflix shares creators 20% make that 25% or more after a company reports it lost subscribers for the first time in more than 10 years. Wow. Who would have thought they're gonna lose subscribers? When they bailed out of Russia, for example, you lost an entire country worth of subscribers. Was it really worth it? I guess Netflix stuck it to Putin, right? They showed him how it's done by losing 25% of their value. Folks, the most important weapon that the United States of America has, it's not nuclear weapons, it's not fighter jets, it's not rockets, it's not farts in a jar. It's actually our entertainment business, our movies, our culture. If you want to have influence in Russia, you gotta keep the movies, keep Netflix, keep McDonald's, keep American culture alive in Russia. But no, we pulled out, including Netflix. And by the way, Netflix is not the only company that's going to get hit by the pullout from Russia. We had a warning from Adobe, for example, a few weeks ago. They're going to lose 9% of their revenue, if not more, due to the halting of the operations in Russia. And right now, it's not just a halt. It's gone. It's not going to happen again. So you have an entire market that this company lost. But this is not even at the top 5 of the problems that Netflix has. The company has many other problems. We'll talk about them in details, but the management at Netflix right now, they're not taking responsibility for the screw-up that they've done. They're blaming it on password sharing. They lost subscribers because we're sharing passwords. Are you kidding me? This is like the Biden administration blaming inflation on Putin. The Putin price hikes. Netflix says our business is fine. Nothing is going on here. We're just losing money because people are sharing passwords. It's not the insane overspending. It's not the shitty content. It's not pulling out of Russia. It's not the hyper woke garbage that nobody wants to watch. It's the password sharing. Oh, really? And now Netflix says they're going to crack down. They're going to bring down the hammer. For all of you who are sharing passwords, You better be ready for the backlash. Netflix goes on with the blame game. They say it's macro factors, including sluggish economic growth, increasing inflation, geopolitical events like Russia's invasion of Ukraine, and some continued disruption from the thing. Wait a minute here. I thought the thing was good for Netflix. Wasn't that the whole story about Netflix growth? Everybody is at home, quarantining and watching Netflix, right? What happened to that? Netflix goes on and blames the disastrous report on the moon, Jupiter, Uranus, Alpha Centauri, but not their insane overspending and the disastrous management led by Ted Sarandos. That's not the problem. The problem is sharing passwords and a million other reasons. And by the way, it gets even worse for Netflix. It's not just that they lost subscribers during last quarter. They're also projecting that they're going to lose 2 million subscribers in coming months. As if Netflix is saying, please sell our stocks. It's garbage. It's toxic waste at this time. And perhaps this is the appetizer for more disasters to come from these streaming companies. Look at this, for example. Netflix says that they increased their share of total US TV time from 6% last year to 6.4% this year. Who gives a shit, right? And then you have YouTube down year over year. So watch out for Google's earnings. But again, Netflix says we're increasing our watch hours. People are watching Netflix more. Who gives a shit? Are they paying money? Are you getting money by people watching more? Of course not. So who cares? This is all about the money. And obviously the management at Netflix know nothing about money except when it comes to their bonuses and salaries and the stocks that they dump millions and millions of dollars worth of stock. But they have no clue how to create revenue, sustainable profits, decent margins, budgeting correctly, and avoiding overspending, for example. And here's one of the greatest calls by Jim Cramer when he tweeted on January 3rd and said, Netflix buy. The stock of Netflix is a buy right now. And guess what? Netflix is down 7 million% since that time. But rest assured, the management at Netflix, specifically Sarandos, Ted Sarandos, he dumped over $50 million worth of Netflix stock right at the top in October of last year, right at the time when Jim Cramer was pitching the stock. And of course, whether we're talking about Fandor Hastings or Ted Sarandos, they're getting paid handsomely. Hastings got paid almost $41 million. Sarandos got paid over $38 million last year. That is on top of the stock dumping. Meanwhile, Netflix shareholders are now down over 65% from the top? How is this not a racket? This is a rigged stock market. Valuations don't matter, where they do now. For all of you who said, oh, valuations don't matter, they do now. But who wins at the end of the day? The predators, the insiders, the pumpers, the 1%. But the retail mom and pops always end up holding the bag. Speaking of holding a bag, and perhaps we should celebrate that it's not just us holding the bag, the retail mom and pops. We have a billionaire investor, Bill Ackman, Snake Bill Ackman, who bought the last dip in Netflix, and now Bill Ackman is holding a massive bag. Yep. So let's look at the numbers and see what went wrong in Netflix's earnings. When we look at the different regions for the company, the UCAN, US, and Canada, all I care about is the paid net additions. In Q1 2022, they lost subscribers. Likewise, in the EMEA, this is Middle East, Africa, Europe, they lost subscribers too. In Latin America, they lost subscribers quarter over quarter. The only region where they gained subscribers was the Asia Pacific. No wonder why they're pumping all of these Korean shows. But here's the problem. The year-over-year growth in revenue was actually down 5% quarter over quarter. So that means they gained more subscribers, but these subscribers are paying less, and hence the revenue is down. When we look at the income sheet, for example, and this is important, the revenue year over year for the company went higher by almost 10%. The cost of revenue, on the other hand, went higher by almost 10 9.75%, almost even here, but here's the problem. When we look at other expenses, for example, like technology and development, that went higher by 25% year over year. The general and administrative spending went higher by a stunning 34% year over year. When you have a company where your expenses are rising higher, the growth in expenses is rising higher than the growth in revenues, you got a problem. It's going to show up in the bottom line. The net income year over year for Netflix was down 6.4%. This is a major problem for the company. So what is the core of the problem from a strategy perspective in this company? This is my opinion, of course. Number one, overspending. They're spending like a drunken sailor, hiring The Rock, Ryan Reynolds, a billion here, gazillion here, and it shows the old guard of Hollywood mentality in Ted Sarandos. He doesn't understand that this is a streaming company, not a Hollywood studio, where you spend like a drunken sailor and you hire the big names, The Rock, Will Smith, Tom Cruise, and that sells at the box office. So you spend 100 million, a billion to make the movie, doesn't matter because it's gonna score at the box office. You spend $1 billion making a movie and then it makes $3 billion at the office, that's a gain. The problem is nobody gives a shit if you spend $1 or $1 billion in making a movie in Netflix. Why? Because there is no box office. You pay a membership fee every month and you watch the content. It doesn't matter if they spend $1 billion to make it or $2 to make it. So the solution here is either getting rid of Sarandos or Mr. Sarandos needs to evolve and understand that this is not a Hollywood studio. This is a streaming business. What does that mean? Instead of spending a gazillion dollars hiring The Rock, for example, to make one movie, which I'm gonna watch in an hour and a half, and then it's gone, poof. Doesn't matter that you spent $1 billion on creating that content. I spent only an hour and a half to go through the content. And then I'm looking for more. And you cannot produce more because you've already spent $1 billion gazillion dollars on one movie. The old mentality in Hollywood, the superstar era, is dead. That is too early 2000s. It doesn't work anymore. It doesn't matter if you hire The Rock, Ryan Reynolds, Mark Wahlberg, whoever, it doesn't matter. You pay them gazillions of dollars. Or whether you hire unknown actors or perhaps really good at their job. If the content is good, it's going to be a score. If it's not going to hit. And either way, there is no box office here. Whether the content cost $1 billion to produce or $10 million to produce, it doesn't matter. The end result is the subscriber's going to watch the content and then they're looking for more. So instead of spending billions, gazillions of dollars hiring these superstars, why not adapt the same strategy that Netflix is adapting right now with a high degree of success? And this strategy is creating the stars rather than paying them to do a movie or a TV show in your platform. For example, did anybody know who Julia Garner was before the Ozarks? Maybe, but not many people. That is a star born in Netflix. And guess what? They did not pay her billion gazillion dollars. The efficiency is important here. Another one. Anya Taylor-Joy, whatever her name is, from the Queen Gambit, that's another star born in Netflix. They didn't pay her a gazillion dollars, but the Queen Gambit was a massive score for the company. The old school thinking of hiring superstars, that's dead. The new school of thinking is creating the superstars in an efficient way. The company is spending too much, and it's a major problem. And of course, look at this. Netflix, last year, the plan was to spend over $13 billion, and they even projected that they're going to spend over $50 billion on content alone. That is insane. Yet Netflix has the audacity to blame the employees for overspending. Wait a minute here. Are the employees overspending by hiring staff that the company needs? Or is it the management that's gone completely haywire? You are in the addiction business. The viewer is looking for more content that's suited to them, which means that the company has to pump a lot of content to satisfy the different tastes for their multi-million subscribers. When you spend $1 billion in creating one content that features The Rock, who gives a shit, you could have spent that $1 billion in creating 10 movies, for example, or even 100 movies in different languages for different audiences. And they could be good quality movies, good quality TV shows. And that leads us to the second problem, the lack of content. You watch something good, a TV show, a movie, takes you a day, a weekend, and then what? You're starving for more. And there is no more. The rest of the content perhaps doesn't appeal to you. And that leads you to pause the subscription. I'm not using it. I gotta wait a month or perhaps 3 months before I get something that I really like. And this lack of content problem is causing the churn rate for the company to move significantly higher. And here's another problem for this company. Once again, you are in the business of addiction, not entertainment. You got to feed the viewers more and more content. You need a degree of consistency. Now, when you dump an entire TV show that somebody can binge and watch in a day or two, you got rid of the consistency. You got rid of the anticipation. You watch one episode and then you have to tune in tomorrow to watch the other one. Now, it's too late to go back to that kind of model because we've already spoiled the audience with the binging model. So it's kind of hard to go back now, but you need consistency. What does that mean? Perhaps certain TV shows, maybe reality TV shows, could be divided in daily episodes. Think about a late night show, for example. That's consistency because the audience has to tune in every single day to watch the new episode. Think about the Maverick of Wall Street channel. The audience is used to the consistency. They get a show every single night and it develops a viewing routine. I hate to say the word, but it is kind of an addiction thing. Addiction is good for business, specifically if the content is good, and this is lacking from Netflix's platform. Furthermore, another big problem this company faces is the fact that they have a flawed business model. If you're going to spend $1 billion creating one movie, the right business model would be a click per stream model. Then you can justify spending $1 billion in creating one movie. But if you're going to dump it for free, included with the membership, what is the point here? The audience is going to watch it for free, and then what? There was a time, for example, in the TV business where there was that sense of anticipation. We watch an episode and we wait another week to watch the next episode. And in between, there is a lot of talk, a lot of hype, which causes ratings to move higher. This is lacking from Netflix because the business model from the get-go spoiled the viewers. You pay us $10 a month and you get millions of hours worth of content. It's kind of too good to be true. The problem is right now, if you increase these prices from 10 to 15 to 20 to 25 to 50, you're going to see a lot of viewers saying, too expensive, goodbye. And this is a major problem, not just for Netflix, but for the companies that enjoyed the so-called growth era. From 2010 to 2020, 2021, the era when the Fed was pumping trillions and trillions and trillions of dollars into the system, crushing bond yields, for example, causing the TINA argument to be alive in the stock market. And what happened? Investors became chasers of growth instead of actual value created by the company. Investors, be it pension funds or retirement funds, every penny that comes out of this country was chasing growth in the stock market. Companies perhaps were not making money, but they were growing those revenues in an insane way because the business model was too good to be true. You give the audience all of these movies and TV shows for $8 a month, I'm taking that deal. And of course, you're going to increase your subscribers dramatically in the growth phase, and the revenue of the company will increase dramatically quarter over quarter, year over year, and investors' dollars chased Netflix stock, for example, because of the growth. And Netflix used the equity value to take on loans and debt and expand more, create more movies, more TV shows. In doing so, they crushed Hollywood studios, who did not have that luxury. Hollywood studios needed to produce content, account for the budget, and they must make profit. If the movie bombs at the box office, they lose money. The movie must make money at the box office. This wasn't Netflix's model. They pump whatever content it is, doesn't matter. They have access to unlimited money due to their equity value, and they don't really care if the movie bombs or not. The strategy was growth at any price, pump as much content as you can, and increase the revenue as much as you can, increase the membership as much as you can. And now comes the moment of reality. The Fed is changing the strategy from the accommodative era that encouraged growth investing to the tightening era, which will encourage value investing. And stocks like Netflix, which are really overvalued, are going to become undesirable under these conditions. And now investors' attitude toward these growth companies, the likes of Netflix, is going to change. Investors are going to ask, are you producing actual profits or not? Because we're not going to appreciate growth anymore. We're looking for tangible gains. We're looking for actual cash. And the company's not producing that. And hence the business model trap. This growth at any cost model, increased memberships at any cost model is going to fire back because the company at a different stage right now. It is at the stage of maturity. And accounting matters in the phase of maturity. You got to produce more profits, more cash flow. This is what investors are going to be looking for in the years to come, which means that Netflix has to either change their business model. It's kind of too hard to do that right now. What are they going to do? Say, hey, we're going to cancel memberships altogether and you're going to pay per stream, for example. You're going to face a lot of backlash from doing that. So the solution for now for the company is efficiency. That is the key word. efficiency. Stop spending more on a single content and start producing more. But even if that happens, there is a major problem when you have a company that started on the foundation of growth at any cost. Let's say, hypothetically speaking, every single human being on the planet becomes a Netflix subscriber and they're paying $10 a pop. What happens after that? Where is the growth after that? The business stagnates. There is no growth. Perhaps it becomes a dividend-paying company, a boring stock. So this membership model has its limitations, and either the company is going to be creative in adjusting the business model, or efficiency is the key. But regardless, we can see right now in the horizon the ceiling for Netflix growth, and this is the core of the problem for this company. And by the way, it's not just this company alone. Many other companies that enjoyed growth in the so-called growth era, the easy money era, now we have to face the moment of truth. But let's talk stock market before we move on here, because we have a call from your favorite analyst. It's not Tom Lee, by the way. It's from JP Morgan, Marko Kokolanovic, who says a rally in the stock market is imminent after investors got too bearish and as inflation starts to moderate. Kokolanovic says the stock market is poised for a near-term rally after investors turned too bearish on stocks. We spotted the rally yesterday because of Bullard's comments, and we got the rebound. Now Kokolanovic speaks out and says, here comes the rebound and the rally. When a week ago he said, take profits out of American equities. Marco, you just jinxed the rally. Keep your mouth shut. You and Tom Lee, stop talking for a week or so and watch how the equities market recover and moves higher. JP Morgan's Marko Kokolanovic says is calling for a rally in the short run after recent tax-related selling. Oh, really? We remain constructive on equities and think that near-term rally is likely, particularly in small caps and high beta market segments. Ay. These pumpers are never going to learn. Their job is pumping on steroids on autopilot. The man said take profits from U.S. equities just a week ago. Now he says you got to buy the high beta stocks. What changed, Marco? Is inflation peaking? Really? Did the Fed change their outlook for the policy? They're talking about it. They're massaging market expectations by appearing dovish. But at the end of the day, inflation will dictate the conversation from this point on. Inflation will dictate the decision-making by the monetary policy from this point on. And inflation is saying, you better be as hawkish as you can get, regardless of what Bullard said, regardless of what Williams said, regardless of what Boystick said today. They're all singing the same tune. Oh, we're already seeing demand destruction in the economy, and hence, the Fed doesn't have to be as hawkish as we anticipated before. Oh, the equities market is doing the tightening for the Fed already, so we don't have to be as hawkish as we thought before. Not a chance. Not even close. Remember what Bill Dudley said. For this quantitative tightening to work and to tackle inflation successfully, you gotta tighten financial conditions. And this happens by two ways: increasing unemployment and crashing the stock market along with the real estate market. You gotta do damage to the economy, to crush the demand, to lower expectations, to wash out the inflation from this economy. And we're all praying that the Fed will manage to do the soft landing. It's a fantasy for now, but we're all hoping that the Fed will manage to thread the needle carefully to minimize the damage in washing out this inflation out of the economy. This is not a period where you can say, hey, just buy equities and we're going back to all-time highs. You gotta be as selective as you can, and you gotta distinguish between fake rallies and legitimate ones. Selectiveness is the key to success in this bear market. Yes, it is a bear market. And with that, folks, we're going to move on to the market information, and we start with the performance of indices today. And here we go. The Dow Industrial Average was up 499.51 points, or a gain of 1.45%. The Nasdaq up 287.30 points, or a gain of 2.15%. That'll be wild if the Nasdaq triples in a single day. But here it is. The S&P 500 was also up by 70.52 points, or a gain of 1.61%. The sector's performances: number 1, leading the pack and capturing the gold medal, cyclicals. Number 2 for the silver, REITs. And a number 3 for the bronze, technology. The laggards of the day, the winners for the year, energy, materials, and utilities. So a little rotation today, perhaps on the heels of the Bullard optimism. But let's see if that's going to hold on or not after the disaster out of Netflix. Here is the advance to decline ratios. NYSE 75% advancing versus 22% declining. The Nasdaq 73% advancing versus 22% declining. Moving on to commodities, a bloodbath across the board. Energy was down big. The WTI down over 5%, so was the Brent. Likewise, gasoline was down almost 3.75%. Heating oil was down almost 1%, and here it is. The dump in natural gas down almost 8% today, erasing the majority of the gains from yesterday. So did the mystery trader that we talked about over the weekend dump? Perhaps. But the tailwinds for natural gas and oil remain intact. Number one, we got the API data, which showed today a decline in U.S. crude supplies. Likewise, when we talk about natural gas, the U.S. storage is down almost 20% from the usual levels this time of the year. So all of that has to be replenished, meaning they're going to have to buy more natural gas. What about softs? The only bright light is lumber, gaining almost 1.75% today. But besides that, everything is down, with exception of cocoa. Cocoa pretty much in the flat line. But we have declines, massive ones for OJ. We talked about OJ and the resistance at around 192. This was an exceptional put options trade, a steak and lobster kind of trade. But again, we saw declines for cotton over 3%, sugar almost 3% to the downside, and then coffee losing almost 1% today. A bloodbath in metals. Gold down, silver down big, almost 3.5%. Platinum is down almost 3%. Copper down almost 2%. Palladium down almost 3%. What about meats? Unfortunately, the new big tech is not keeping the gains from yesterday. It is down about 1%. So was feeder cattle, be it in the flat line, and then we have modest gains of about 0.5 percentage point for live cattle futures. Grains, unfortunately for my trade, rough rice is down a little over 2.5% today. We'll see how that's going to hold in the next few days, but we have wheat down almost 2%. So is corn. Corn is down a little over 1.25%. And then we have soybeans, soybean meal, soybean oil, oats, canola, pretty much in the flat line. Moving on to the big casino, the options market. What do we see here? The volume remains shy. What does that mean? We're not seeing participation in the buying. The majority of the buying that we saw today was short covering because of Bullard's comments, perhaps accompanied by some algorithmic buying. But we're not seeing institutional buying. We're not seeing even the retail crowd buying a lot. The options volume is down all in all, but Apple at number one by far at around 800,000 contracts traded today, about 65% of those were calls. Tesla, number two, at around 420,000 contracts traded today. About 62% of those were calls. At number three, AMD, with around 350,000 contracts traded today. About 66% of those were calls. And look at Twitter. The volume is down big, so was the stock. Down almost 5% today. So all of the Twitter puts gang, raise your glasses. Moving on to the unusual activities that took place in the options market today, we start with the ticker NCR for, you guessed it, NCR. The buying calls on the name, the 45 calls for the expiration date, May 20th, with expectations that the name would move higher by more than 6% by then, and they paid around $1.50 a piece to enter. This trade, all in all, spending around $2.3 million. What about the ticker MOS for Mosaic? Although we have a viewer who keeps reminding me that it is Mosaic. And I say, f that shit. In this channel, we say Mosaic. Mosaic is for bitches. Anyways, they're buying puts on MOS. Natural gas is going down, and so will MOS if natural gas goes down. A lot of you have the FOMO, and you've been asking me, should I buy Mosaic and Nutrien at this point? And I say be careful because FOMO is for the dumb. We've been talking about these names for almost a year now. And now you want to chase them higher? Good things will come to those who wait. Wait for a pullback, and if the fundamentals remain intact, you hop in and you buy the dip. But for now, somebody's bidding for a downside for MOS by buying these 70 puts with the expiration date April 29th. With expectations, the name could go down by more than 10% by then. They paid around 55 cents a piece to enter. This trade, all in all, spending around $700,000. What about the trade for the ticker EWG, the Japanese the Japanese ETF, they're buying puts, the 52 puts for the expiration date June 17th, with expectations that the name could go down by more than 10% by then. They paid around 50 cents apiece to enter this trade, all in all spending around $500,000. What about the ticker BIDU, Baidu? In a lot of pain, but perhaps there is more pain to come, at least according to this trade. Somebody's buying the 120 puts for the expiration date, April 29th, with the expectations that the name could go down by more than 5% by then, and they paid around $2.25 apiece to enter this trade, all in all spending around $2 million. What about the ticker SNOW, Snowflake? Well, they bought the 210 calls betting on a rebound for the name with the expiration date of this upcoming Friday, April 22nd, with expectations that Snowflake could move higher by more than 6% by then. They paid around $1.40 apiece to enter this trade, all in all spending around $1 million. And lastly, what about the trade for the ticker AMD for, you guessed it, AMD? They're buying calls this time around, betting for a massive jump higher for the name. They bought the 109 calls for the expiration date May 6, with expectations that AMD could move higher by more than 12.5% by then. They paid around $1.45 apiece to enter this trade, all in all spending around $1 million. Moving on to the heat map analysis, what's going on here? We're seeing a mini baby rotation out of energy and materials and fertilizers. ADM, for example, was down. LMT, the defense contractors, were down. The rotation from the winners to the losers. It was a baby, mini, unnoticeable one because we haven't seen massive dumping of the winners, but we saw a lot of buying of the losers. The big caps, the high beta names, the RKKs of the world, the software names, the industrials were all higher today. The cyclicals, in specific, were higher today. And the notable loser is Pfizer. In the morning, we got earnings out of Johnson & Johnson, and the company did not give a rosy outlook for the jabs, and therefore Pfizer got a hit today. Here are some of the notable movers. Some important news for individual companies. We start with Apple. We have a New York store right now. The workers at that store are demanding a minimum wage of $30 an hour to keep up with the inflation costs. At this point, it doesn't make sense for them to work at the store. Because if you're getting paid less than what your expenses are, what is the point of working? Factor in rent, utilities, gas, etc., and the workers are now demanding $30 an hour. And the question is, are we about to see what we've seen out of Amazon being replicated in Apple, for example? What we've seen out of Starbucks being replicated in Apple stores, for example? That will be a massive hit to the company. Not because it's a massive expense, but from a PR perspective, from a wage inflation perspective. We also have news for Disney. We have Florida Governor Ron DeSantis, who asked the state on Tuesday to consider ending the special tax district, which was established before 1968, and this special tax district favors Disney. So in other words, Governor DeSantis is hitting Disney from a political standpoint. And I say from the get-go for all of these companies, don't get involved in politics. Stick with business. Stick with what you do best. Entertainment, parks, content. We also have news out of Moderna. Moderna is announcing a step toward updating the Thing shots for this fall. So they're already preparing, by the way. They're setting the stage for the upcoming jabs because the Russia-Ukraine narrative is not working anymore. The stick it to the Putin narrative, it's kind of fading away, specifically now that it appears that Putin is going to eke a win in Ukraine. So they have to go back to the narrative of the thing and the jab and the unjabbed and the demonization of the unjabbed, yada, yada, yada. Or perhaps they will come up with something new to keep the sheepies busy. But for now, Moderna was down, what was it? About 1.25% today. Not a big loss. But the name is down big year to date, and it is down massively from the top. We also got news from Delta Airlines. They're collaborating with SpaceX to test the Starlink satellite internet technology on board of their jets. We'll see how that works out. But we have more news out of airlines. Spirit Airlines are cutting some spring and summer flights to head off disruption. And they say they're cutting off these flights in anticipation of bad weather, quote unquote. Bad weather, wink wink. In other words, Spirit Airlines is saying, we're running out of staff. Please help us. And lastly, the winner of the day was, believe it or not, Plug Power, a name that retail investors were really a fan of during the heat of the mania of this bubble. And of course, Plug Power is down big from the top. But It rebounded higher today on this news. Plug Power snags Walmart fuel deal as green hydrogen revs up amid oil price hike. Or price spike, doesn't matter. What about the heat map for the ETFs? Green across the board, with exception of the recent winners, energy, the XOP, XLE was down, but besides that, everything was higher. And growth outperformed value, both in the green, but growth outperforming value. On the other hand, the VIX was down. Commodities were down big, whether we're talking about gold, whether we're talking about uranium, whether we're talking about silver, whether we're talking about gas, all down. And perhaps it was the beginning of a rotation out of commodities into the losers year to date. We're talking about technology, we're talking about biotech, we're talking about the cyclicals, but perhaps things will get interrupted after the bell by the disaster out of Netflix. And the last thing I want to talk about is the KRE, the regional banks ETF. It was up big today, and I tweeted this yesterday. As the yield curve steepens, I'm liking regional banks again. So we're going to continue to ride on the KRE until the yield curve, watch the 2 to 10. If that starts to curl down toward inversion again, then we're going to dump the KRE and regional banks altogether. But after all of these financial earnings from big banks and some regional banks, I'm liking the regional a lot more. Less exposure to dangerous areas around the globe, be it Russia, be it bad loans, and you're getting more benefit from the rise in yields. So stick with the regionals. We're moving on to the charts analysis, and we start with the SPY, and this is a 30-minute chart. What do we see here? We talked about the sloping line of resistance. Today, we got what we asked for. Number one, a pop higher above the sloping line of resistance. Number two, making a higher low. We got both. And now the SPY is consolidating in a bull flag pattern. We have the support at around 443. We have the resistance at around 446.5. Now you might ask, what will Netflix earnings do to all of this? Netflix, believe it or not, is a tiny, tiny component of the SPY. It is a component of the Qs, and it could have more impact on the Qs than NASDAQ. It will only hurt the SPY if we see a bad reaction out of the big caps. Apple, Tesla, Microsoft, if they go down in empathy of Netflix earnings, then we got a problem in the SPY and the chart could lose 443 once again. What about the daily chart for the continuous contract for the SPY, the S&P 500? A nice pop higher, far above 4,384.5, so the bulls can breathe a sigh of relief. And even if we have a down day tomorrow, for example, so long as the bulls are holding on to 4,384.5, things are improving. The ABC pattern could happen. The bull flag pattern could happen. Many other bullish patterns could take place. But once the chart loses 4,384.5, then we got a problem, a big one. Look at the volume today, for example. It spiked higher on the buying side. The momentum indicators were curling their way higher. Everything was good and set up for a move higher, perhaps to recapture 4,472 as support. And then came Netflix's earnings. The reality check that things are not really good underneath this economy. Things are not really that good when it comes to corporate earnings. We called this earnings season the hunting season because we will see many other bombs besides Netflix. Here is a 30-minute chart for the Qs, the NASDAQ. We talked about the reverse head and shoulder formation in yesterday's video. We talked about important levels of resistance, be it 341. That was defeated today. On top of that, the bulls recaptured 343. Important progress today. We talked about 343 being a weak support because it kept failing over and over and over again. And it needed one of two things. Either the chart going down to 334, perhaps below that, and then catching technical support on high volume and making it back all the way above 343. Or something in the fundamentals has to change. And we got that in Bullard's dovishness yesterday. That did the deal, and now the chart is above 343. The chart is facing soft resistance at around 347, and it stopped pretty much exactly at that. Now, you bet that Netflix's earnings will take a bite out of the NASDAQ, at least in the morning. So we could go back all the way down and retest 343, for example, or maybe 341. If the chart loses 341, abort it's going to get ugly. If the chart loses 343, not a big deal so long as it rebounds of 341. Here is the daily chart for the continuous contract for the Nasdaq. The good news for the bulls from a daily chart perspective is they recaptured 14,000 as support. The bad news is they could lose it as soon as tomorrow. The volume went higher on the buying side. Everything was looking good. The momentum indicators were moving higher. And then came the chop from Netflix. We got to wait and see what happens here, folks. Losing 14,000, not a good sign. If the chart closes the day below 14,000, then we have more pain to come. Closing above that number, and the hope is still alive for the bulls. What about the IWM 30 minutes chart for small caps? What's going on here? We got the rebound once again of 196.5. A massive move higher. Now the chart is facing the resistance, the soft resistance at around 201.68. It is consolidating in a bull flag pattern. Will the Netflix disaster ruin the party for the IWM? Perhaps. But again, small caps have no exposure to Netflix at all. They're more concentrated in the reopening part of the stock market, the cyclicals, the hotels, casinos, cruises, and the likes. If the positive energy in cyclicals continue, then we will see the IWM making it all the way to 204.5. And the bull flag pattern will play out. The Dixie, the dollar index, what's going on here? It continues to pop higher, and therefore we're seeing commodities down, gold down. Commodities, we're betting that the dollar is cooling, but every time you think the tricky Dixie is cooling, it pops higher again. And by the way, I cannot do everything for you in this program, but you can look at the Excel sheet out of Netflix, the details, and you put 2 and 2 together, and you can spot the margin erosion clearly in Netflix's earnings by the rise in the US dollar. If they're gaining subscribers and revenues from Asia, for example, well, these earnings have to be converted into dollars. The dollar is too expensive. It is way higher than the currency they received those revenues in, and that crushes the margin, and therefore the net income went down negative among many other reasons. And here it is, the daily chart for gold. It took a massive leg down in today's activities. Is it going to lose 1,925? Look at the MACD indicator, for example. It's about to cross down, creating negative impressions in the histogram. The gold bugs, hold on to your diapers. Let's see how New Mount Gold's earnings come out on Friday, and then we'll take it from there. What about oil? Brent oil, this is a 4 hours chart. A decent pullback, erasing perhaps a day or two worth of gains, and now it has to go down or retest 105.84, and then we'll take it from there. A rebound, specifically a big one, will be healthy for oil, and the dip will be worthy of buying, but if it fails 105.84, you gotta wait till we see the retest of 100. And here is natural gas, a 15 minutes chart. I'm leaving all of the markings that we talked about in the 5 minutes chart in yesterday's video, And as you can see, we talked about 7.7 as an important support line. The moment that is broken, run for the hills, goodbye, because we will see a flush down. This is exactly what we got today. Where is support? Support number 1, when we look at the daily chart using the Fibonacci retracement, support number 1 will be around 7. If that doesn't work out, the nat gas could go down another 12% or so to the next support at around 6.3. Moving on to the daily chart, for the 10-year yield, it continues to move higher. Every time you think this chart is topping, it slaps you right in the face, Will Smith style, and it says, I'm going higher. And how do you play this, by the way? You can buy the ETF, the TBT, although it's getting a little risky. You can play it another way, perhaps a safer way, by buying the KRE, regional banks. They benefit when yields go higher. But you got to also look at the yield curve, because if the yield curve is inverting or becoming negative again, banks are not going to do good. You need a steep yield curve. You need a steepening of the yield curve for regional banks and even big banks to perform. Here's a weekly chart for the TLT. I know a lot of you are buying TLT calls. Perhaps we're getting closer, but I told you, the technicals don't matter right now. We gotta wait for the fundamentals. Do we have a piece out of the Fed's policy, for example, or the macro calendar that could support a top in the 10-year yield? Perhaps. I cannot spot anything right now, but we'll know when we know. The fundamental news will come out. You'll see the 10-year yield dropping like a rock, and you will see the TLT popping higher significantly. You want to buy calls right now? Go ahead, but make sure that you understand 2 things. Number 1, you got to give yourself enough time for the trade to work. Number 2, there could be a lot of pain before that bottom happens, so use spreads to minimize the damage if it happens. Here's the VIX 4 hours chart. What's going on here? We're seeing negative momentum on the MACD indicator. The chart cannot make it above 24.29. We have a negative divergence on the RSI of the VIX. Everything is pointing out for more gains for the SPY, unless two things happen. Number one, we see an improvement in the momentum indicators, meaning we see a reversal of the negative divergence of both the RSI and the MACD. We see the chart trading above 24.29. And here's the VXN, the VIX for the NASDAQ, looking a lot better than the actual VIX. It is keeping the support of 27.5. The momentum remains positive for now. The assumption is we will see a pop in the VXN right after the drop of Netflix, and then we'll take it from there. What about Apple, daily chart? We're having a rebound higher today, but again, it didn't even make it to the half of the body of the reversal candle, the red candle. And it didn't even make it to retest the upper range of the trading channel in yellow, which is resistance right now. But we're seeing some improvement in the RSI, curling its way higher. Perhaps it is on its way to reverse the negative divergence. We'll see about that. But again, there's nothing to do here until you get earnings. You cannot buy, you cannot sell, you gotta wait for earnings. Tesla, an hourly chart, what's going on here? The bulls continue to buy. They buy call options, they buy the stock. There is a level of resiliency in this chart. It made it all the way back to 1,025. We'll see what happens from that point on. We're going to get earnings from Tesla tomorrow. It is highly anticipated. Fireworks. We're all waiting on what Elon Musk is going to say. And unfortunately, there is a distraction because we're all waiting for what he's going to say about Twitter, not Tesla. But we're getting bad news out of Tesla, folks. The Shanghai factory closures are going to take a bite, no doubt about it. On top of that, we're now hearing really bad news, awful news out of Tesla, the same factory in Shanghai. The workers are now forced to sleep and eat on the floor of the factory. Will Reverend Elon Musk give these workers the freedom of speech to complain, for example? It's an interesting question to ask. And we're also seeing the regulators dropping the hammer against Tesla, be it the regulators finally investigating safety concerns or the racial discrimination suit in California. And now we have Tesla removing the mobile chargers. The setup doesn't look good ahead of earnings for the souffle. What about tulips, BTC, Bitcoin? Any update? Not really. The bear flag is still here. The chart is not above 42,000. There's nothing to see here at all. AMC, where are the apes? It was a good day for AMC apes. The name finished the day with gains of over 7%, almost 7%. And I was holding calls, so it was a good day. I took about 75% of the position off. We're done. Steaks and lobsters, baby. Yet I'm still keeping about a quarter of the position in. Let it ride in case AMC has more gains to squeeze. The problem is, after the drop in Netflix, do you really want to hold in these calls or expect AMC to continue to move higher? We might shift back to risk off. Then AMC goes down again. But for now, the momentum got hit really hard. It got really oversold. The implied volatility was really down. And it is in the initial stages of reversing that negativity, of building back the implied volatility, of reversing the momentum indicators from negative to positive. So there could be more gains to come. But after a pop like this, like we got today, always want to book some profits. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have existing home sales, and then we have the Fed's Beige Book. We got more Fed zombies speaking from San Francisco Daily to Chicago's Evans, and then we have Atlanta's Fed zombie Boystick speaking. He was on CNBC today, by the way. What do we have on the earnings calendar? We have Procter & Gamble in the morning. Highly important. Then we have United Airlines, Alcoa, Tesla, Lam Research, and Carvana. The most important earnings will come out of Tesla, but all of them will be important indicators of the economy. Procter & Gamble, are they still able to pass the inflation cost all the way down to the consumer? What about United Airlines, the jet fuel cost? What about Alcoa, the slowdown in China? The demand for aluminum, for example. Tesla, the most important one for many other reasons. Lam Research, the health of the demand on semiconductors. And Carvana, once again, will it negate the negativity out of CarMax? We'll see. But this is all I got for you for now, folks. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.